And we've got an exciting second session. We're going to dive into more depth now, focusing on private finance. We're going to look at how we can foster private finance, private investment for the Sustainable Development Agenda. And as you take your seats, it's my pleasure to welcome Ms. Shanaz Patel, who's going to moderate the session. Shanaz is from the EU delegation in Indonesia, covering Indonesia and Jakarta, from Jakarta and the ASEAN region. So Shanaz, please, the floor is yours.
Good morning, everyone. If I could call my guest speakers to the stage to join me, please. Dr. Nirwan, thank you. Mr. Pai will be joining us online. Just checking that Mr. Pai is online. Can you hear us?
Yes, I can hear you, but the host has to switch on my camera. I'm unable to switch on my camera.
Yeah, yes. Sorry for that. All right. Good morning, everyone, and welcome back to the second session of the Regional Knowledge Exchange event. It is a pleasure for me to be here and moderate this session on fostering private investment in the Sustainable Development Agenda, a topic that is also a high priority for the European Union and its engagement in the Asia-Pacific region. As we come together, we find ourselves at a critical juncture. The challenges we face to reach the SDGs requires coordinated efforts of massive scale. While governments and international organizations have long been at the forefront of driving sustainable development, the private sector's role has become increasingly prominent. The fast growth of the Asia-Pacific region has created a significant demand for investment in infrastructure, energy, and other sectors that are essential for sustainable development. This requires a significant increase in financial resources, and private capital plays a crucial role in bridging the funding gap. At the same time, to meet the SDGs, we need to ensure that private investments, especially when it comes to these sectors, respect the highest social, environmental, and quality standards. This is also at the core of the European Union Global Gateway Strategy. However, harnessing the full potential of private investment and its alignment with the principles of sustainability requires a supportive ecosystem and an enabling environment. This is where the ENFFs can play a key role in facilitating and accelerating this process. During our discussion today, we aim to explore what are the challenges and opportunities in the region surrounding private investment in sustainable development and hear from our speakers their insights and experiences on how we can collectively foster an environment conducive to mobilize private capital aligned with the Sustainable Development Agenda, and the policy frameworks, regulatory mechanisms, and financial instruments that may get us there. Without further ado, I am delighted to introduce our guest speakers of this session. They represent the different actors of the sustainable finance ecosystem. From the regulatory and government side, we are joined by our Honorable Dr. Nirwan Noor, Deputy and the Secretary of the Ministry of Finance of Malaysia. From the banking side, we welcome Mr. Poonsing Wongtawachai, Executive Vice President and Head of the ESG Division at Krungsri Bank, in representation of the Thai Bankers Association. Representing both the business community and civil society, we are joined by Mr. Alvin Wee, Executive Director of Philippine Business for Social Progress. And finally, representing the investors community, we have online with us Mr. Ramraj Pai, Chief Executive Officer of India Impact Investors Council. So, to get started, if I could ask Dr. Noor, The effective regulatory reforms and strong partnerships across governments, the private sector, and development finance institutions are needed to foster an enabling environment for increased sustainable finance uptake. Can you tell us what are the main reforms that are now taking place in Malaysia to establish such a conducive environment for sustainable investments? Thank you.
Thank you, Thank you, Shanas. First of all, I would like to thank the UNDP for having the Malaysian delegation here. It's a privilege to be here, actually. And also, thank you to the Thai government or Thailand in general for the warm hospitality. With regard to the question just now by Shanas, may I just share the journey of Malaysia in the INFF? So basically, after we ratified, to have the commitment towards SDG 2030, we have been gathering a lot of information, and both from the public and private sectors. And then we realized that there is a gap in terms of information from the private sector side, and then their contribution, which we believe it is much more than what we have been doing in the public sector. So that's why, in terms of financing, we do have readily available information from public financing space, but it is very difficult for us to actually gauge or gather information regarding what types of projects, how much have they, gather or generate funding for certain projects, and who are the target groups that, some organizations or the financial institutions are targeting. Because for the attainment of SDGs, I think it's not just for Malaysia, but for all countries, we need to gather complete information from the public and private sectors. So that's why we thought it is very important for Malaysia to have the INFF in place, so that we could basically start off by gathering the main policies of the government, the long, medium, and short-term measures and projects that we plan to have. Then we will identify what are the challenges ahead, and then what type of financing is required, whether certain projects supposed to be carried out by the government or the private sector or some NGOs, although it should be blended by the different groups. So from the public sector or public financing, we do have the annual budgeting from the Ministry of Finance. And then normally the delegation will go to the ministries, and we will basically identify the relevant projects, building infrastructure, etc., through our annual budgeting process. But we also have our regulators that work with the private sector, especially the central bank, the Securities Commission, who are looking at channeling our financial resources through financial institutions and also to the investors to carry out a lot of projects. So that is the most important thing. And then we basically, through INFF, we realized that our private sector colleagues are way ahead of the government sector. For instance, when we're talking to the Bank Negara Malaysia, the Central Bank of Malaysia, they already got the principle-based taxonomy. The Securities Commission already have the SRI roadmap, just to guide and get private sector players to channel the resources into projects related to ESG practices, trying to basically finance affordable housing, things like hospitals, agriculture-related projects, and all this, which we really need. And also in Malaysia, we do have it's a new program We call it My SDG Foundation, which is a trust fund, which we try to call for contribution from other than the government, from philanthropists, from individuals, private sector, be it from domestic or international community, to contribute towards the areas which are unreachable by the government, sensitive areas, like stateless people, etc., because these people also will be part of the whole SDG framework. So we are working on that as well. Okay, thank you.
Thank you, Niran. Now I turn to the banking sector and its role in sustainable finance. Mr. Punsit, banks are under rising regulatory and commercial pressure for better climate risk management and to align with the global sustainability agenda. So banks are increasingly incorporating sustainability considerations into their lending decisions and improving disclosure on climate-related information. TBA has been actively promoting sustainable banking and responsible lending in Thailand. Can you tell us what are the key initiatives and the progress made by the banking industry in advancing more inclusive and greener financial products and services? And what is the role of sectoral associations like yours in helping a sustainable financial industry to grow and make greater commitment to support the country's inclusive and climate-friendly economic growth? Over to you.
Okay, thank you, Chanel. I think, as you mentioned, right now we are under, a regulatory development. And if you ask me, I think Thailand right now is at the inflection point, meaning that, our key regulators in the banking sector, namely the SEC, the Security Exchange Commission, the Bank of Thailand, which is our central bank, and also, with the Stock Exchange of Thailand, they are now trying to actually promote or prioritize, sustainable finance and sustainable banking as a key pillar to drive the growth and the development in terms of green or sustainable financial products and services in support of the Thai government, SDG goal, as well as the Paris Agreement, commitment. So, in short, with the regulators are actually pushing forward in term of paving way, to drive, the financial sector and its participant, to be supporting, the national agenda in terms of SDG, as well as, our climate change, action. The Bank Thailand actually, outline or publish what they call the future financial sector landscape last year, of which, the key component is that the Bank of Thailand would like to see the banking sector, to perform our intermediary function in terms of channeling capital to a more greener or more environmentally friendly project and business. And therefore, there's set a certain expectation that banks need to integrate ESG or sustainability in the process of, business strategy formulation, integrate that into our BAU in terms of our business operation, as well as expect us, to be able to provide the financial product and service of which will lead to the net zero achievement for Thailand, the real sector, as well as our customer. So on this note, as, the Thai Banker Association, as an industrial association, we actually also declare what we call the ESG declaration in August of last year, of which, the direction of our ESG declaration is also in line with the central bank expectation. We are publicly committed that, as an association or collectively, we will, conduct our business in terms of our banking business to be in line with, with the UNPRB principle of responsible banking, as well as, the certain, criteria and standard on sustainable banking. And we also highlight that, to achieve, that type of commitment, We also need to have, a good governance in terms of the accountability at the board level, at the management level. We also need to have our strategy in terms of, again, the provision of financial products and services. And we also need to have, our risk management in place in terms of, our ability to assess, both, in terms of, ESG and in particular, climate change risk that will incur to the process of, business and operation of our commercial bank. And to that end, with that commitment, we are now working with the regulator because the regulator, the central bank, is also due to issue what we call the taxonomy. The taxonomy is basically a classification of economic and business activity, a classification of sub-sector industry of which, whether they are green or they qualify as, less green or brown activity. So that, as commercial bank has a commonality in terms of reference and definition on the sector or the business activity that we would like to actually target. So with that, expectation from the regulator and with our, public commitment in terms of our ESG declaration. So right now, we are actually working very closely with the regulator to come up with what we call the industry handbook. Okay, this industry handbook, will entail basically a minimum standard for all of us, commercial banks in Thailand, to be in alignment with. So that way, we can achieve, what we have committed to the public in terms of our declaration, and also we can meet, with the regulator expectation, whether it's, the financial sector landscape or whether it's the taxonomy, which is also to be the issue by the Bank of Thailand. So in a nutshell, this industry handbook, which is being developed jointly, between us, the Thai Banker Association, and our regulator, the Bank of Thailand, is that, it will set out, or it will outline a minimum standard that, us commercial bank need to at least have in place. So, with that somewhat level playing field, I think it will actually move, the sustainable finance development, and also progress in Thailand in a significant manner. Thank you.
Thank you, Mr. Punsit, for your insights. Now I turn to Mr. Pai online. The impact investing market globally and in India in particular has grown significantly in recent years. Big ticket deals have more than doubled in the past 5 years or so, with the number of deals in the $20 million and plus range having increased by a factor of 2.3 times. Mr. Pai, could you tell us about the potential you see for impact investing as a driver of sustainable finance and some of the policy initiatives of the Indian government that help facilitate the impact investing landscape in India? Thank you. Over to you.
Thank you for the opportunity. Thank you to UNDP and all of you. Unfortunately, I couldn't be there today in person for this event. But let me just quickly share a little bit of perspective on the social finance and impact investing market in India. So India has had a long history of, what we would call as targeted finance or social finance. The Indian banking sector today has to, by regulation, allocate 40% of its advances to what we call as the priority sectors: agriculture, MSME, renewable power, affordable housing, and so on and so forth. India also has leading development finance institutions for agriculture and MSME, which direct credit to these sectors. The whole space of impact investing is something that has come up in recent times. Essentially, the whole idea of impact investing is to invest in companies which are for profit, but have a strong balance between social impact and financial returns. So you need to be able to create social impact as well as generate tangible financial returns, preferably market-linked financial returns, not just average financial returns. So these are companies in the spaces of education, agriculture, health, climate finance, climate change, climate mitigation, and so on and so forth. Many of these companies are trying to use newer technologies, innovative technologies, breakthrough technologies to try and convert some of these problems into real solutions. And as you had mentioned, this is a market which is growing very rapidly. On an average, this is a market of at least $3.5 to $4 billion every year, growing at about 20-25%. A lot of these startups, a lot of these innovative solutions are funded by regular venture capital as well as impact venture capital. The government of India, in its wisdom, has, undertaken a variety of activities to support these kind of companies. To start with, the Securities and Exchange Board of India, or the SEC equivalent, has launched detailed guidelines for the setting up of social venture funds, as well as for the setting up of social impact funds. What happens when with these regulations is large amounts of institutional funding can enter this sector through social venture funds or through social impact funds. So this really enables many large institutions and other organizations which may not want to enter the regular venture capital market, but may be very keen to enter the venture fund or the impact fund market. So I think this is one big agenda that the government has worked on very actively. The second area, which is a very innovative thing, which we will talk about a bit later, is the setting up of a social stock exchange. And for the first time, the Securities and Exchange Board of India has also taken extensive efforts to set up what I would loosely call an entire social finance regulation and audit ecosystem. So the SEC or the SEBI has actually defined a social enterprise, which is, in our view, one of the very challenging things. What is an impact enterprise? What is a social enterprise? This is something that they have defined. What kind of audit standards should a social enterprise or should an impact enterprise go through? What will be the kind of audit requirements of an organization like this? Does the Institute of Chartered Accountants, which is the the audit standards board in India, do they have the right kind of standards to be able to audit these organizations? Do the chartered accountants need a self-regulatory organization to be able to ensure that they follow a certain degree of rigor in kind of figuring out how to audit and manage these organizations? So what the SEC has done over the last 1 to 1.5 years under the ambit of the social stock exchange is created an almost end-to-end, if I may say, monitoring and audit ecosystem for social enterprises in this country. And the aspiration is that under this ambit of the social stock exchange, can you guys hear me? Hello?
Yeah, we can hear you, yes.
Okay, you can hear me, right? Okay. So the whole idea is under this entire regulation, the whole idea is social finance enterprises, whether for profit or not for profit, can come and get listed on the social stock exchange, can raise funding, either for profit, equity or debt funding, or it can also raise grant funding through not-for-profit enterprises. So the whole idea is to create an entire ecosystem through which we can encourage social finance, whether it is from commercial finance sort of solutions, or through philanthropic grant, or through blended financing. So that in brief, and I'm going to stop now, is really that entire ecosystem which the SEC, the Government of India, and other players in this country have tried to set up. Let me just stop there and happy to take any more.
Thank you, Mr. Pai, for sharing the experience of India. I now turn to Mr. Alvin. Philippine Business for Social Progress is the largest business-led NGO that operates at the nexus of corporate citizenship, sustainable development, and poverty reduction. PBSP has also played a key role in the INFF process in the Philippines. Being uniquely positioned to be representing both the business community and the civil society, can you reflect on why establishing a platform such as INFF is important? Thank you.
Thank you, Shanaz. Let me just start off, and I hope you can indulge me. Today is the 125th anniversary for the Philippine Independence Day. So in 1998, June 12,
Congratulations.
this small archipelagic whole in Asia-Pacific said, we'll govern ourselves after 3 centuries with Spain and a rich history and culture before that. So we celebrate all the Filipinos here. Happy Independence Day. Everyone here who loves the Philippines and Filipinos. It is our 125th Independence Day. For those of you who might not be too familiar with the Philippines or are somewhat familiar but have not revisited our country in a few years, let me just give a quick recap as well. As a population, we are 110 million people strong as of 2020. As a landmass, we're about 300,000 square kilometers. That's about the same size, slightly smaller than Malaysia and Vietnam, and about 60% of Thailand. In terms of income, we are at about $3,400 GDP per capita. That's as of 2021. That's unfortunately only half of half of Thailand. I should correct myself. We're at about the same size as Vietnam, although they're ahead by a few $100s. We're less than half of where Thailand is in terms of GDP per capita, less than a third of where Malaysia is. And our median age is only 25.2 years old. It was as young as 23.2 in 2010 and 24.2 in 2015. It's a young population, a lot of promise. Some of you might know it's a beautiful, if not somewhat chaotic country. I would argue that the chaos is part of the beauty of the Philippines, but my colleagues might have other opinion on that. And on the question on what the INFF brings in terms of value, for the Philippines and much of middle-income, low-income countries worldwide, and actually the rest of the community of nations, we are so far behind our 2030 global goals commitment. We were behind even before the pandemic. We remain, and we are even more behind now after the pandemic. For the Philippines, for the 17 global goals, especially the critical ones, no poverty, good health and well-being, good nutrition, quality education, decent work, responsible consumption, and production, we were behind those major indices even before the pandemic. Because of the pandemic and some of the responses to the pandemic from the country, in 2020, we suffered our worst recession in recorded history. Our economy contracted by nearly 10%. We lost over 4 million jobs. More than 8 million Filipinos suffered pay cuts as a result. And we had 5 successive quarters of economic contraction that only ended second half of 2021. The good news for the Philippines, since that time, we have been steadily climbing out of that hole. We are one of Asia's best performing economies since last year, since in fact second half of 2021. And some of you might argue, economists will argue that's base effects. That is true, it is base effects, but we'll take any win that we can get, right? Because of the pandemic also, our poor Filipinos have increased significantly. So pre-pandemic, 2018, 16.7% of our population, 1 out of 6 Filipinos were considered poor. That's about 17.3 million Filipinos nationwide. With the pandemic, that number ballooned to 19.99 million poor Filipinos throughout the country. And that's an 18.1% poverty threshold. That's still the lowest in more than 2 generations. In 1985, our poverty rate was 49.2%. So we have been languishing in this part of the world for several decades. For a long time, apart from being Asia's first republic, one of Asia's oldest democracies, we were considered the sick man of Asia. We didn't industrialize or modernize or develop as fast as our neighbors in the 70s, 80s, and 90s. We were slowly turning things around. and we've achieved some pretty significant development outcomes as a result. I'd argue, as someone who's now in civil society, but as someone who has also worked in the private sector, I do have an engineering background. I did product management, business development in private telecommunications in the Philippines. And then I joined government for a brief time, 5 years, with our Ministry of Education, more than a decade ago. And now I'm in civil society. What I personally feel and see about the Philippines, we are punching below our weight. Meaning, for the kind of development and income and resources that we have, and the talent and ingenuity and intellect and passion of Filipinos, we're not achieving as much as we should in terms of poverty reduction, fighting inequality, having fantastic education and learning outcomes, having better health indices as well. And just overall, our human capital development. Our human capital index is only 0.52. So every Filipino born today would hope to achieve about half of their potential by the time they say goodbye to this planet. That is a grave injustice to every Filipino. That's a grave injustice to much of us in the global south or in the low and middle income countries. The good news, because of things like INFF, collaboration among UN agencies, private sector, civil society, and everyday citizens, there are real efforts, number one, to look at and to do an independent check on how well the country is really doing on the global goals. Of course, we have very capable, very dedicated public servants from our Philippine government. You'll hear a lot from them tomorrow morning. But government or citizens should have an independent check. How well are we doing with SDGs 1 to 4, 7 and 8, so on and so forth? What else? What has been working? What can we do better? The INFF effort in the Philippines answered some of those questions. But more importantly, it also looked at how can we and where can we channel more resources towards the global goals achievement in the Philippines. Now that we're at the halfway point and considering what the pandemic has the effect of the pandemic to the Philippines and to our most marginalized and most vulnerable communities, what the kind of hockey stick trajectory that we need to get on. Now, it's easy, and I'll end with this one. It's easy to look at the larger problems and say, oh, this is just too much. This is just too much. We can't possibly catch up to 2030 considering every challenges that we're facing now. I'd like to think, glass half full, we know where we stand. We have a better idea today than 3 years ago what the challenges are and literally how much we need to make it happen. We do have a number. It's not perfect, but it is a number. It's something both governments and private sectors can work on. And we may or may not hit the 2030 commitments, but we will die trying. Not literally. We'll die trying because it is the 125th Independence Day of the Philippines and because our country and every Filipino deserve a better Philippines. Thank you.
Thank you for sharing your thoughts, and happy Independence Day to you and all the Filipino participants here and the ones joining us online. Come back to you, Mr. Nirwan. Could you share with us your thoughts on the role the Malaysian government is playing in nurturing a sustainable investment ecosystem? Who are the key stakeholders in the system, and how can they contribute to increase the private sector investment to finance the development agenda? Can you also reflect on how the ENFF approach can help in building such an ecosystem? Thank you.
Okay. Thank you, Shanas. As I mentioned earlier, the Securities Commission basically is leading or is regulating the private sector, especially the investors, in terms of channeling the resources to various areas, projects and programs. It is also them who regulate our stock exchange, and they also lead in terms of requiring these players to disclose their activities. You know, the disclosure element is very important to me, and it is part of a really strong initiative. You know, you can call it a reform also within the ESG practices in Malaysia, which requires, you know, public listed companies and also the big companies to disclose their sustainability related activities. You know, how are they contributing towards ESG practices. So through this exercise, guided by, you know, sustainable and responsible investing principles, they are able to bring everyone on board in terms of trying to ensure the whole supply chain. You know, we're talking about the big companies with the chain of suppliers, you know, which are the mainly the small and medium enterprises, to be aligned with what the companies are focusing on. So we think this effort will continue to be practiced by all companies, because the big initiative currently is towards green economy, sustainability, and all these companies have been reporting in their annual reports, you know, and then making pledges that they are going for net zero emission by some say by 2035, some said they're going to be net zero by 2050. So this is very important for the government to see the private sector is leading and way advanced and trying to meet the international standards. That's why Malaysia had already launched the voluntary carbon market last year in 2022. It was just decided in 2021 for us to have it. And Securities Commission with Bursa Malaysia managed to make it happen within just a year. And the voluntary carbon market, VCM, is very important, very useful for the private sector who has this commitment towards certain years to be net zero, for them to offset the GHG emissions, you know, trying to align themselves to sustainability principles. So we hope the same spirit and the same similar practices will be shown, and, you know, will be a reality. And we hope the private sector will continue to contribute to the achievement of SDGs by 2030. Thank you.
Thank you, Mr. Nirwan, for your reflections. Coming back to you, Mr. Punsit, could you please share with us the role that you see the banking system in Thailand can play in driving investment in a more sustainable future? What are the key motivations for Thai banks to participate in the space of responsible banking, and what are, in your view, the key challenges? Over to you. Thank you.
Okay. As I mentioned earlier, you know, we are working together with our regulator. You know, we are, you know, establishing our own commitment and our own vision in alignment, you know, what the regulator would like to see in the Thai financial sector. And on that note, okay, we hope that, you know, in the very near future, you know, we'll see bank, you know, will be a very important driver or catalyst, you know, to drive or to mobilize, you know, capital into the real sector or to the real economy, of which that are in great need in terms of, you know, transition or transformation toward, you know, a more environmentally friendly, you know, business operation and practices. Okay, we also, you know, would like to see, you know, the commercial banks, you know, to integrate, as I mentioned earlier, the ESG agenda or ESG consideration into their, you decision-making process into their business strategy formulation and also into their risk management practices and standard. Okay, and I think with the industry and taxonomy in place, the bank or the financial sector can systematically evaluate the environmental impact, including opportunities and risks, as part of their decision making. And obviously, individual banks, need to also take into account that, each one of them, have their risk appetite, and therefore, they, with their portfolio, there could be some different. But at least, I think, we will have, the common standard or the minimum standard that will apply to all, our player in the system. And obviously, with, all this, ESG risk integration and policy formulation in place, we do hope that we'll see adequate, financial product and service that we provide to meet the need, of the economy or the need of our business client, for their net zero or that decarbonization target. And I think, the regulator also play a very important role. We do need, certain support or incentive from the regulator because, private sector capital or private sector fund mobilization alone could not be enough or could not be sufficient. A case in point is that, our regulator, the Bank of Thailand, actually provide or establish, a soft fund, what they call the soft loan, for the SME that need to transform their business operation last year. So these are some of the, example that could actually help, our private sector operation and also execution, to, toward achieving our, sustainable finance or our, SDG goal and target. And you mentioned, in terms of the business opportunities, and key risks or the challenge. I would say that, obviously, one of the key risks in Thailand is that Thailand, by and large, we are still economy that rely heavily on fossil fuel. So a drastic or a rapid transformation or transition could actually, had an adverse impact, on the real economy, especially with the SME sector. Could, a certain, drastic measure could actually impact, their business operation or competitiveness. So I would say that, with, our goal in terms of supporting the economy to transit, we also need to, keep in mind that, certain business sector or certain, our customer segment could be more impact. So we need, to actually take into account, or we actually need to provide additional support to the sector that could be, more, impact, adversely by our action. And I guess, as I mentioned earlier, we would need, the market mechanism, to actually operate. And as I mentioned that it will probably be better, because the amount of investment or the amount of the required investment that we need, in the economy are quite massive. So, private sector alone cannot be actually adequately, or sufficiently, addressed, to close this gap or to, to overcome this challenge. So I think, a good example that we have seen, not in Thailand, but, in our neighboring country like Indonesia and Vietnam, the program, this is what they call the JETP program, the Just, Energy Transition Partnership Program, of which mobilize funding from both private sector and public sector together with, the multilateral development bank, toward, to manage, the phase out, of the coal-fired power plant. Also, to provide additional or accelerate, capital that will flow into, the renewable sector. So these are some of the examples that, of which we obviously identify as a challenge. But in the meantime, we also see it as a great business opportunities, and that, I think we will require, the collaboration or the collective effort, from private sector, public sector, and also, the multilateral or multinational development banks. Thank you.
Thank you, Mr. Punsit. Mr. Pai, if I could come back to you. The Securities and Exchange Board of India approved last year the setting up of the Social Stock Exchange. The board also published in October last year a detailed framework for that exchange that will operate within the Bombay Stock Exchange, the country's largest. Non-profit organizations and for-profit enterprises working towards creating social impact could list and freely trade their shares on the exchange for a range of socio-economic causes such as healthcare, education, and affordable housing. Can you tell us, Mr. Pai, what is the idea behind the stock exchange and how will it operate? And what needs to be done to expand and strengthen the SSE in the future? Thank you. Over to you.
Thank you for that question. So I'm just going to give a quick overview of the social stock exchange and how it works. So essentially, the whole idea of the social stock exchange is essentially to create a market for both for-profit as well as not-for-profit enterprises which are working in the social impact space. As far as the for-profit organizations are concerned, those which have a serious social impact also along with their financial return. So when I say for-profit enterprises, these are organizations which are creating a lot of social impact together with generating financial returns. For these organizations, this provides a very good platform where they can raise money in the form of shares, just like any other listed capital market that operates. There is not much difference. But what could be a very unique thing, especially for the for-profits, is there could be a lot of philanthropies, there could be a lot of foundations who are interested in organizations which may not be able to generate 20-30% return on equity or 20-30% return on shares, but they are able to create a very strong social impact. So what happens is this creates a market for social enterprises which possibly create huge social impact, but maybe their financial return may or may not be good. If their financial return is good, either way they will get very popular on the market. But there could be many organizations where the financial return is not that good, but still they are able to generate some return but create very huge social impact. So for these organizations, social stock exchange is a great place. Now let's look at the second type of organization, which is for a not-for-profit. These are NGOs or people who are doing great work in education, health, whatever other sector you can think about. How can we create an institutional platform which will enable these people to raise money? So today what happens? If a not-for-profit wants to raise money, what will it do? It will go to some large foundation, submit a project report, all kinds of things will happen, maybe 6-8 months of back and forth, and then the money will be raised. What the social stock exchange is trying to do is create an institutional mechanism through which these not-for-profits can raise financing from a wide variety of stakeholders. These could be local residents, these could be domestic philanthropies, these could be international foundations, these could be all kinds of people who are providing money for any kind of social charitable project. Now, this is one of the very good initiatives to provide scale to the not-for-profit sector. I think somebody on the panel was mentioning that the needs of our social finance post-pandemic have only increased. The need for capital has increased. The need for capital has increased. How is it that we can create institutional platforms where more capital can come in? So the whole idea of the social stock exchange is really to create this kind of a platform where anybody, right from residents up to large philanthropies and foundations, can co-participate in a project which has been audited, which have the blessings of the Securities and Exchange Board, which has very extensive governance standards from the Chartered Accountants Authority and so on and so on. So that is the whole idea. The second idea of the social stock exchange is really for these not-for-profits. And there is a very unique innovation that has happened that I must talk about here, which is called the zero coupon, zero principal debenture. Because normally what happens on a stock exchange is you list a security. Now, when you talk about a security typically has, you are paying back some amount, you are giving a return, you could be giving a dividend, or you could be, returning principal and interest. What happens in the case of a grant? A grant is not a security. So what the Securities and Exchange Board has innovated and created a unique instrument called a zero coupon, zero principal debenture, which means to say you invest in a debenture or a bond, but it has zero redemption in terms of principal and zero redemption in terms of interest. This is a unique new sort of system. The last thing that I want to talk about as far as social stock exchange is concerned is this whole space of blended finance. Now, this is a very, very important market, especially when we start thinking about sustainable finance. All the people on the panel have spoken and told us that commercial finance will not enter sectors where there are very high risks, and it will not be possible for them to enter because they have a sort of, if I may say, fiduciary duty to their shareholders or other people. So they cannot take inordinate risk. At the same time, you have philanthropies, foundations, governments, and other people who want to ensure that these sectors move ahead. How do we really do this? Is really through a blended finance structure, which essentially uses some form of concessional capital or grant capital and blends it either with equity or with debt. And essentially, the grant provides leverage in the transaction, enables sort of debt or equity to come in. So let's say $1 of grant funding can essentially raise maybe $3, $4, or $5 of equity funding or debt funding. These blended finance transactions will enable far more capital to go to the social finance sector. But without that $1 of grant funding, that $4 of commercial finance will never come in because the risks could be too high for commercial finance to come in. So the whole idea of the social stock exchange is also to encourage these blended finance transactions, enable more people to participate in these blended finance transactions, and get these blended finance transactions in a way listed on the social stock exchange. Please note that a lot of these are not meant for trading. So we are not looking at a market where people are buying and selling some of these. Some of them could just be a one-time market discovery also. So that is really what it is. It's a great idea. I think a lot of work is happening in trying to get the first listings done. Obviously, there are some challenges. Investors are used to investing in their own way. So why should they come on a platform? What kind of incentives can we create for investors? These are some of the challenges that the government and the Securities Exchange Board are grappling with. But overall, it's a great concept, essentially bringing the entire ecosystem together to support social finance. And I think this platform is very critical because for anything to scale, I'm sure everybody on the panel will agree, for anything to scale, you need regulation. Sometimes regulations can be difficult, because we have to change the way in which we operate. But if we really want any market to expand, lots of investors need the blessings of the regulator. They need the regulator to acknowledge this market. They need the regulator to make the rules so that they can follow the rules. Maybe initially the rules seem a bit difficult, but over a period of time, at least in my experience, no market that has really scaled in a sustainable way has been unregulated. So regulation is very, very critical. And I think some of these initiatives from the local SEC, SEBI, have proven to be really a shot in the arm to the social finance market. Let me stop there.
Thank you, Mr. Pai, for sharing your experience with us. Mr. Alvin, if I can direct the last question to you before we move to the audience questions. Back in the 70s, 50 business leaders founded the PBSP and committed themselves to social development and poverty reduction by setting aside 1% of net income before taxes to fund PBSP and support socio-economic development programs. Now, more than 50 years later, please tell us how this private sector initiative has evolved, and are we seeing the same level of financial commitment from businesses today? How is the Philippine Business for Social Progress helping to mobilize financing to the SMEs, and are there any innovative solutions that have been piloted?
Thank you for that question. So we started in December 1970, incorporated a few months after that. 50 of the most important businesses in the Philippines, local and transnational, were part of that 50 founding members. As Shana shared, the initial commitment was 1% of net income before taxes to social development, 20% of which would go to PBSP. It actually followed a Venezuelan model in the 60s and 70s. The bad news, out of the founding members who are still there, I think only one company has maintained that commitment. And I say it's bad news with some levity because we've been in the game for half a century, more than half a century. We've also evolved with the corporate and for-profit sector in the Philippines and much of the world. So in the 60s and 70s, it was really about philanthropy. By the 80s and 90s, you have corporate social responsibility, which intersects a lot with the balanced scorecard Everything now has to have KRAs and KPIs. Everything has to be measurable. All investments should have clear outcomes and outputs. And then now, the space is really evolving towards creating shared value, inclusive businesses, and being aligned with the global goals. The good news for PBSP, we are as robust as we've ever been in our 52 years. Every year, we marshal and we disburse anywhere from 55 to 70 million US dollars in SDG-linked investments. But maybe the not so good news, more than 95% of that are really from international development donors. In fact, most of that is really just the tuberculosis grant from the Global Fund to fight AIDS, tuberculosis, and malaria. So unlike a lot of the countries here, the principal recipient for the HIV, malaria, and tuberculosis grants to the Philippines isn't government, it's non-profit or for-purpose organizations. PBSP for tuberculosis, if you would believe it, the foundation of Shell, yes, the fossil fuels company Shell, having the principal recipientship for malaria and HIV grants from the Global Fund. But overall, we've enjoyed a lot of good, we have a good track record. Businesses, government, units, local community, civil society do work and do trust PBSP. But as has been mentioned in the panel, the challenge remains is that we are nowhere near 2030 and we are nowhere near the level of resources, public and private, that is required to really make a dent towards 2030. The good news, for example, for us in the Philippines, because of INFF, we learned, in fact, that our top 4 major sources of SDG financing, in this order: private investments, domestic; government revenues; private borrowing, international; and then government borrowing, domestic. The ones that typically get media attention, or the ones that are sexier, I should say: foreign direct investments, FDI, government borrowings, international, and official development assistance. Those are 6, 7, and 8 respectively out of a list of 9. So yes, those are very important levers and resources for the Philippines, but the top 4 are very critical. And let me boast a bit, because it's our Independence Day. We kind of have an ace in the card that is not common across this region or amongst all low and middle income countries. We have a healthy base for our international remittances. So more than 10% of our population live abroad. More than 10% of our gross national income are from foreign remittances. And increasingly, we're also seeing a lot of Filipinos who do want to literally invest in the Philippines. So rather than just getting the traditional blue chips, a lot of them are also getting into bonds that are linked to green and climate and other SDG-linked outcomes and indicators. So all of those are all emerging spaces for the Philippines. They're still not growing as fast as the need dictate that it should, but we're getting there. And I think with better collaboration, better data availability and transparency, and just having the right people in the same room, government and non-government sectors, talking about this, I think I'm quite hopeful, cautiously, about where the Philippines stand in this entire effort.
Thank you, Mr. Alvin, and to all our panelists for their insightful interventions so far. So now we'd like to open the floor to our audience members. We still have time to take up a couple of questions, so please, if I can see hands raised. Any volunteers? Yes, please. If you could kindly state your name, the organization you represent, and to which panelist would you like, are you directing your question to?
Thank you very much. I'm Amara Durrani, Assistant Resident Representative at UNDP Pakistan Country Office. My question is for Mr. Nirwan No, the Deputy Undersecretary from the Government of Malaysia. Sir, you mentioned that you are having some kind of an intervention around the setting up of a fund. In your presentation, there was a brief reference. Would you care to elaborate some further information and what is the approach? What has been some of the experience? How forthcoming is the private sector for that ostensibly public-private partnered fund? Thank you.
Thank you for the question. I think you were referring to the MySD Foundation, which is an incorporated trust fund. Basically, the project is a collaborative project between the government of Malaysia and the UN, with our UN country office in Malaysia. So basically, the aim of this fund is to gather contribution from various parties. Of course, the government has already given the launching grant for that, but we also will work together with the UN to bring in more funding into the trust fund. So how it works, it's basically MySDG Foundation will be the caretaker of the fund in Malaysia. The contribution will come to MySDG Foundation in Malaysia, and then we will transfer some amount, most of the fund to UNMPTFO. So there is a UN Malaysia SDG fund, trust fund created under MPTFO. So the first call for proposal was just launched on the 1st of June, and then the deadline is on the 14th of July. So for the first round of the call for proposal, we mentioned that the proposal should be focused on people-centric programs and projects. So as I mentioned earlier, the purpose of having this fund is to provide financing to vulnerable groups which are quite sensitive, unreachable by the government and also the private sector. Maybe the private sector is not, doesn't have interest in those programs apart from carrying out CSR projects. But we also would like the fund to be able to provide sustainable financing or funding to NGOs and CSOs who may be having some fund, but in certain years they may be short of funding to carry on the programs. So this is the purpose of having this fund essentially. Thank you.
Me first. I don't know where to stand because okay, my name is Muyu Shideruf. I'm the blended finance expert with the Bangkok Regional Hub. So my question is to Mr. Vongtachau, if I'm correct. Okay, so because we know that blended finance is a very important and new topic. So it is how to mobilize commercial finance using some donor funds or concessional funds. So my question is, the banks traditionally provide direct loans to their customers. So what are the challenges for the banks to participate in such blended finance structures? Thank you.
As I mentioned, for us, to adequately, channel or provide capital to the needed sector, often, we see those sectors as a high risk because the business sector that need to transform or transit, obviously there are risks of not being able to effectively transform their operation to be, somewhat, a greener, or more environmentally friendly, business operation. So therefore, I think it's very important that the government, or as I mentioned, the multilateral development bank, that also come into play, in the form of, co-investment, or perhaps, concession, interest rate to help, not only to lower the financing costs for the bank, but which also importantly to share risk, of which, the private sector alone may not, ready or may not effectively take on, on their own. So I think it's very important, the blended finance, or, the joint partnership, between public and private sector, are actually, I think, a very important mechanism. And I personally see, more of this type of, financing arrangement, in the coming years, because otherwise, although there are a lot of, financing need, among many, industry, many sector, or many segments in the society, but of which, private sector alone will not be able to sufficiently provide support. Thank you.
Sorry to be the third UNDP person speaking. I do hope after lunch we'll hear less of UNDP in the UN and more of our colleagues from government and the private sector. What a great set of presentations, really exciting progress being made. I just wanted to perhaps reflect upon the challenge of the previous session, which is really about scale. And we heard from the Maldives, and I may be getting the figures not exactly right, but $5 to $10 billion of investment required over the next 5 years. We heard from Mongolia, I think, $44 billion of investment required to 2030. And I worry a little that the processes that the colleagues have outlined are incredibly strategic. They are aiming at systemic change. But I want you to also share with us the challenges you see in reaching the scale of investment from capital markets we need for sustainable development. I think the colleague from the Philippines really highlighted that. You gave a figure of, I think, $55 to $70 million of investment in sustainable development. And then I know. And then highlighted how much of that was with the Shell Foundation, right? As I understood, for malaria and HIV. Just there, the contradiction, lays bare that there we're talking about the 55 to 70 million, but what about the hundreds of millions that Shell invests in other sectors? Also on the social stock exchange in India, fantastic initiative, but will we ever get to the point where the whole of the stock exchange is looking at its social impacts? And finally on ESG, of course ESG really fundamentally is about managing risk to financial return, but can we get to a point where we look at all investment in relation to financial and development return? So I just wanted to highlight some of those challenges I think we're all aware of, but maybe that we need to be a bit more explicit about as we discuss moving forward. Thank you.
Let me start. The challenge, but also the opportunity for the Philippines. Pre-pandemic, our Securities and Exchange Commission required all publicly listed companies to make their annual ESG disclosures. Don't quote me on this, and I will deny it if they watch the recording, but I doubt the SEC actually reads those reports. And maybe less funnily, I think there has to be better government effort to really account for these ESG/SDG investments across the board. INFF, I think, showed the way with that one, how it has provided tools to government to really tag their budgets and their outputs to specific SDG targets and objectives. I think government can do the same. In fact, as Philippine Business for Social Progress, I'm also part of the boards of several of the most impactful local, non-government, and civil society organizations in the Philippines. One of which, the Association of Foundations. This is the largest network of non-stock, non-profit corporations in the Philippines. We have 227 member NGOs and CSOs nationwide. Every year, we do what we call our network aggregate report that looks into the combined and aggregate investments in health, education, environment, livelihood, inclusion, other areas that you can actually link to SDGs. The 2021 number is about 13.5 billion pesos. So that's still about $200 million. It's small relative to what our government is actually spending on social services, social protection, all of these SDG targets. But what we always say, it's $200+ million dollars that is within the control of the private and development sector, and that we can use to leverage and amplify and complement government programs. So that's, I think, one of the main challenges for us. The other is, and I forgot to say this during my last answer, one of the things that we have been trying to do as PBSP and as a interface between private sector and civil society, if you go to the annual budgets of my member companies, we're typically a line item as corporate social responsibility or corporate citizenship. That's not core business. As we learned during the pandemic, that's one of the most discretionary expenditures for a for-profit corporation. And in times of hardship, they'll flick that away. The battle or the opportunity also for us, we have to move from corporate citizenship, corporate social responsibility, to the actual core businesses. How can we make it the core business of fossil fuel companies, of pharmaceutical companies, of large retail, food, tourism companies and industries to really link with specific development outcomes and targets of the global goals. We've done a lot of work. The country has done a lot of work over the past 10+ years. I was there when Sustainable Development Goal number 4 was finalized in Incheon in 2015. So I can say with actual certainty that we've done a lot in this area, but there's still a lot more that we need to do. And really, time is running out.
Regretfully, we have to draw this panel discussion to a close. I would like to once again thank our speakers for sharing their reflections and insights with us present here today and those following the event online. Our discussions have shed light on various aspects of private investment, from responsible financing and impact investing to the importance of a conducive environment for sustainable finance. Private investment holds immense potential to drive sustainable development, but it is not without its challenges. However, these challenges also present opportunities for innovation and transformative partnerships. Throughout our conversation, we have recognized that the Asia-Pacific region holds a unique position as a thriving hub of economic growth and opportunity. It becomes clearer that by aligning business practices with the principles of sustainability and leveraging the enabling power of the ENFFs, we can accelerate progress towards the achievement of the SDGs. Moreover, strengthening in the region a conducive environment for sustainable finance with taxonomy, sustainability-related disclosure, and green bond standards is essential to redirect private capital from international and domestic institutional investors where it is the most needed for a green and just transition. To truly make sustainable development a reality, we need a range of partners working together. Governments, civil society, financial institutions, and businesses must collaborate and align their efforts. By fostering an ecosystem that encourages responsible and sustainable private investment, we can unlock resources, expertise, and innovation on a scale that is essential for achieving our shared goals. I would like you to join me in a big applause to our guest speakers. Thank you very much.